Hello, everyone. Thank you for joining us, first of all, on a Saturday evening. So, today we're going to talk about the current investment climate for fixed income, right? So, as you all know, interest rates have been going on an upward trend, right, over the past 1 year. And the attractiveness of debt is also going up. So, I have a short presentation and post which we can have a Q&A session. So if you have any questions, right, you can leave it on the chat box. And I will get to those once I'm done with the presentation. Okay, so let's get started. Right, so let's start with a brief of what's happening in the US, right? So when COVID hit, the Fed started printing money to support people with their stimulus checks, right? And the interest rates were also brought down to zero. So the impact of these actions, right, were felt only later, right? And inflation started shooting up. So when inflation went to the highest point since the 1970s, right? So the Fed is still fighting inflation with the most recent print coming in at 3.7, which is much better than where they were in June, right? Where as recently as June, inflation was at 9.1%. So the Fed's tolerance band for inflation is at around 2%. So even the 3.7% may not seem like a high number, right? But it's still much above the Fed's tolerance limit of 2%, right? It's about 50% higher than that. And so interest rates are now in a band of 5.25 to 5.5%, right? And what the expectation is now like is that there'll still be one more rate hike before the end of the year. And also the Fed expects to hold rates higher for longer than they previously anticipated. And they've also, and the expectation is also that the economy would cool down with the amount of tightening that's already been done, right? And monetary policy, when you take any sort of policy action, it always works with a small lag, right? And it's abundantly clear that they still perceive inflation as a threat. And the pace of the rate tightening, right, has also had shorter term yields, which is the US 2-year, right, shoot up, and there's also an inverted yield curve, right, and this has traditionally been a sign of an upcoming recession, although we've had inverted yield curves at multiple points over the last year or two, right? And the US economy is still expanding, right? And the data also supports an economic expansion. And the Fed aims for a soft landing where they can still avoid a recession, right? Even with slowing down the economy, they can still avoid a recession. So that's what's happening in the US. So now if we turn our focus to the domestic scenario, right, things look excellent. So we have buoyant equity markets, although at this point, some segments of equity is overvalued, right? India is set to become the fastest growing, emerging market economy, right? We have more than enough foreign currency reserves, and crucially, the rupee has depreciated the least among all emerging economies. And more recently, so yesterday, right, JP Morgan has included the Indian government bond in their emerging markets bond index, right? And this has been a long time coming, right? This is a long time in the making. We've heard of bond index inclusion ever since like a couple of years ago, right? And an interesting data point is that this index inclusion alone, right, could bring up to $25 billion into the country, right, as foreign investment. And these are only initial estimates, and this is only for JP Morgan's, index, right? And there might be more players also, like more, asset managers coming in with India in their emerging markets bonds as well, right? And that would increase investments even more, right? So let's talk about risks. So the risks in India are also to do with inflation, mainly food inflation, right? The rainfall across the country in July was great, but in August we have had a deficit, right? And inflation is still above the central bank's tolerance of 4 to 6%. And most recently, it was at 6.83%. And food inflation has been coming down, right? Food inflation is down from around 11.5% in July to 9.9% in August, right? So what is a flat yield curve, right? And that's the title of the webinar. How do we invest in a flat yield curve? So I'll start by telling you what a flat yield curve actually is. So if you look at the x-axis on this graph, right, it has the duration of some of our government bonds. So I've taken the 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 15 year, and 30 year. If we go more than 10 years, there are a few more options that you have. But for what I'm trying to convey here, this should be enough, right? The duration is essentially the timeline to which they will mature, right? And on the y-axis, you have the bond's current yields. Essentially, the return on your investment you get on the bonds as an investor, right? So now traditionally, the yield curve would be upward sloping, right? It would go like this. Whereas now it's more like this, right? It's more flat. Whereas traditionally, it should be upward sloping. So this way, the investor would get, compensated for the higher duration risk when it's an upward yield curve, right? A flat yield curve can occur in two ways, right? A flat yield curve can get solved in two ways. So when short-term yields, move down significantly, or when long-term yields move up significantly. So now if we see the yields across the 2 year to the 10-year range, they're trading within 7.2 to 7.15 levels, right? Where the investor is not getting adequate compensation for the increased duration risk, right? So when you when you invest for 2 years and when you invest for 10 years, you would want some sort of difference there for the extra duration risk that you're taking. And that we are not seeing on the yield curve right now, right? So again, this can get resolved either when long-term rates move up or short-term yields move down, right? And this issue should ideally self-correct when things get better, or when there is a a spur in demand for the short-term yields, right? Then when bond purchases start happening, the yields automatically start moving down. So when there is an excess demand for the shorter end of the yield curve, you'll see short-term yields move down and the yield curve self-correct. So let's look at how we can make good investment choices even in this environment, right? One way is to look outside of government bonds and government bond funds, right? So this would include corporate bond funds or high quality deposits, right? So high quality corporate deposits are yielding anywhere between 7.4 to 8% right now, right? For a 1 year to a 5 year time period, right? It's trading within 7.4 to 8% range. And in the mutual fund space, you could match your investment duration to your goal timeline and stick to the short term. So when investing in mutual funds, look at something under a 5 year duration or like a 3 year duration, right? That would give you a better option than going for something super long term, right? And you could also match your investment duration to your goal timelines, right? And that is always a good practice to do. If I'm to give you any examples, you would invest in an ultra short or a low duration fund if your goal timeline is under 1 year, or you're looking to park some money for any emergency situation, right? Or you could invest in a short to medium term fund, right, with the goal of 1.5 to 3 years, right? And another option you can look at is high quality credit. And this does carry some risk. So we have to be careful on the quality, but you generally tend to get a higher yield for the same amount of duration. You could also explore opportunities in bonds and AIFs, right? Although they might carry more risk, depending on the particular type of security or the fund, right? And they come with a higher ticket size, right? So the initial investment is much higher than what you would invest with a deposit or a mutual fund, right? And finally, you can explore asset allocation opportunities. This is something we encourage everyone to do, not only fixed income investors, not only equity investors. We encourage everyone to do it, right? Where you would partially invest in other assets like equity or gold, right? Even though this carries some risk, if you have the risk appetite and your time horizon is on the medium to longer side, this is a great option. And the allocation can also be tweaked based on your risk profile. So say you're someone who does not want to take much risk at all. You've been a fixed income investor your entire life, right? You don't know how equity markets work. We could do something like an 80-20 or a 70-30 to as 70 in fixed income and 30 in equity, something like that, right? And that would give you that bit of higher return over a period of time. So let's explore some options further. Right? So corporate fixed deposits are offered by non-banking entities, right? So think something like a housing finance company, right, or a vehicle finance company, something like that. So they generally offer around 0.5% more than your large banks, if you think HDFC, SBI, right? For the same amount of, for the same duration, they offer about 0.5% more, right? You usually don't get as many options as a bank FD, right, in terms of the investment horizon, but you do have multiple options here as well, usually ranging from 1 year to 5 years, right? Bank FDs tend to offer more on both sides. So some may offer special deposits as well. So something like a 15-month, 18-month, right, or like 22 months. So you have multiple options here to tailor to your, goal timeline, right? And you also have the option to receive regular income starting from monthly, quarterly, and semi-annually. You can also pick for an annual payout, or you can choose a cumulative option, right? Where the income generated every year is reinvested back into the FD and you get a higher yield, right? That's your ROI. And this is and these are some features of corporate FDs, but one thing that you need to keep in mind, right, is that when investing in non-bank FDs, is that they are not covered under the deposit insurance scheme, right? So Usually with FDs, you have something like 5 lakhs. So something up to 5 lakhs, right, is covered under deposit insurance. But that option is not available here, right? So you have to make sure to, invest in the highest possible quality of corporate fixed deposits as possible. So let's look at mutual funds. So debt mutual funds are one of the best choices that you can make, right? They're an excellent choice. They offer multiple options, both in terms of risk profile, like if you're someone who does not want to take much risk, you have options like AAA rated corporate bond funds, you have government bond funds, and if you're someone who doesn't mind taking a little bit higher risk, you have credit funds as well. And also you have options based on the investment horizon. So anything ranging from overnight to liquid, which, overnight is like a 1 day rollover, right? Liquid funds are, something like 1 to 3 months, right? You have options, ranging from the shortest possible duration to like a 10 plus year duration, right? So every investor has something in offer when it comes to debt mutual funds. So how do they mainly generate income? So they generate income through capital appreciation, right? Although you have the option of, income distribution plans or doing an SWP, if you, require that regular income. So when we talk about returns from debt mutual funds, they are market linked. So there might be fluctuations on the NAV. But unless there is a significant credit event in your debt mutual fund portfolio, or there has been a significant rate hike and you've taken something like a 7-year, 10-year duration fund, you won't see that many fluctuations. It would generally be a linear sort of NAV appreciation, right? The biggest advantage of a debt mutual fund is that it would be highly liquid. So this means that if you're faced with an emergency where you need the money immediately, you can withdraw the money and have it credited to your bank account in 1 working day. Let's look at another investment option. So bonds are another great way to invest in debt. But there are a few things that you must keep in mind when investing in a bond, right? And the first thing would be liquidity, right? Make sure that you can lock in capital for the duration of the bond. So what I'm saying is selling the bond in like midlife, right? If you're buying a 10-year bond and you want to sell it within like 4 or 5 years, the option is there. It is not impossible, but in most cases, it's not immediate, right? Bond markets here in India are fairly illiquid right now, right? And finding a buyer and negotiating prices can be a bit of a challenge, although it's not impossible, right? And in most cases, we do need to take the help of a third party, right? And secondly, you would have to keep in mind the credit risk that you're taking. So we must look beyond ratings and into the underlying businesses, right? When it comes to investing in a bond. Some companies are of truly high quality, right? And they could have a rating, upgrade in the cards. And some might have huge red flags and they could be due for a downgrade here. Right. And you'll only get to know this when you go through a company and, you go through what they've done, what they're doing, how the financials are. And make sure and make sure you as an investor are comfortable with the risk that you're taking here, and only then should you go ahead, right? And another thing we need to keep in mind is that the barrier for entry in bonds is generally higher than your FDs or your mutual funds, right? Most bonds would start at a face value of around 5 to 10 lakhs, and this is for one bond. So you cannot subdivide it, and you have to make investments in multiples of 5 lakhs or 10 lakhs. So say I have a 5 lakh bond and I want to buy 3 bonds, and sorry, I want to buy for 12 lakhs, right? I can't buy 2 bonds and subdivide the other 2 lakhs, right? I'll have to buy either 2 bonds for 10 lakhs or 3 bonds for 15 lakhs. Those are my only options, right? And yeah, so that's for bonds, and they generally would offer higher returns, right? Even with good risk protection covenants, right? If you were to explore like AA or single A spaces, right? Even with good covenants, you generally tend to get a decent ROI with bonds. So a general misconception that people have is that all of the fixed income space is safe and is easy, and this has led them to take drastic actions, and some have had a negative impact. Right? This is what we call something like exuberance in equity, right? Where you don't care where you're investing and you just invest in the market, right? This is not exactly a like for like comparison here, but it's a similar sort of attitude. So some primary examples would be the LVB bank crisis, the Yes Bank 81 bonds, right, and the PMC bank crisis, right? Franklin Templeton shutting down 6 schemes in 2020. It was in April 2020 due to pressures on liquidity. And in 2018 and 19, we have had the ILNFS and the DHFL defaults. So what I would tell you is don't just look at the return number, right? So when we're looking at debt mutual funds or bonds, right? In debt mutual funds, it's the YTM, right? Most investors go to just the highest YTM number and just invest in that, thinking that it's safe, it's just fixed income, it's just debt, it's like an FD, right? Nothing's going to happen. This is not true, right? When you have a really high YTM number, right? Think of it as higher risk, higher returns. Same concept. When you have a higher indicated return, you are automatically taking that higher risk, right, for that number. And in a lot of cases, right, you could lose a portion of your capital at that time. Same thing with bonds, right? If you're looking at like a 12, 13% bond, chances are the bond has some red flags. If you suddenly get information that there's a 16, 17% bond, chances are the bond's sub-investment grade, the bond's been downgraded, right? This happened with, I believe, Lakshmi Vilas Bank in 2020. Right, where the bond was coming in at 16, 17% yields right after it was downgraded. Right, so there are a lot of red flags in the market, right? Please keep an eye out. Like if you don't know what you're doing, best get the opinion of someone, the opinion of a professional. Right. So please reach out to us if you if you need any assistance in this regard. Right. So before we move into questions, we have a WhatsApp community where we share regular insights on fixed income. Right. So I'll copy the link and paste it in the chat. And if you're interested, please join. Okay, so now we can get started with the Q&A. First, fixed income is suitable for how many years and how long can I hold? Okay, so fixed income, you can invest in fixed income for as long as you want, right? Even if you're investing in a 1-year duration or a 3-year duration fund, you can hold it for as long as you want. Like the fund constantly changes, right? It's just the indicative duration would be 1 year or 3 years throughout the life cycle. So say if I'm running a 1 year fund, right? I'll I'll have to rebalance the fund after after it matures. So close to maturity, they'll start rebalancing the fund. Close to like 10 months, right? You start to see the fund getting rebalanced, and then it'll run for another 1 year and another 1 year and another 1 year, right? So you can hold on for as long as you want, right? And someone who's looking for a shorter term investment, say like 1 to 3 years, something below 3 years, right? They should definitely consider investing in fixed income, right? Because equity as an asset class works over the long term, right? It'll work magic. But over the shorter term, the general tendency of equity is to be a little bit more volatile. So you'll have, more risk in that regard. But if you do have something of a long-term goal and you want to follow something like an asset allocation model, right, for your investments, then yes, fixed income is a great option. Can I invest in a money market fund where the timeline is 1 year? Yes, sir. Yes. Money market funds generally have they generally have instruments that mature in 365 days, or the duration of the fund would be 1 year or lesser. So yes, it would work well for a 1 year investment. Is it safe to invest in market-linked debentures? So for MLDs, it depends on the issue that you're looking at, and it also depends on the issuer that you're looking at. So for your query, I would suggest that you get in touch with us. I am putting the contact info on the screen right now. Yeah. So I would suggest that you get in touch with us, and we can take it further, right? You can tell us what issues you're looking at. We can give you our opinion and probably more options as well. Corporate FDs and NCDs are not the same, sir. So a corporate FD is a fixed deposit structure. It's the same structure as your bank FD, right? Whereas an NCD is a bond. And they're raised by specific companies through the markets, right? And the fundamental structure is different. Whereas in FDs you have multiple options of multiple payouts. Bonds generally only offer one option, right, for the duration of the bond. And bonds generally come in a single sort of duration. Like you'll have a 10-year bond, and it'll mature in 10 years. You won't have multiple options like, a 1 year, 3 year, 5 year maturities. Is this an MF strategy? I don't understand this question. So fixed income can, be played through mutual funds or the PMS as well. We have a PMS called Sphere, which is multi-asset. We do have a small exposure to, fixed income in, that asset. But yes, we can invest through mutual funds as well. If you're looking for a pure fixed income exposure, then the mutual funds, deposits, and the bond strategy is the great option. Is Nasdaq index investing good for the long term? Not right now. Right now, both the S&P and the Nasdaq are a bit, overvalued, right? But if you're looking to do something like an SIP and you have something like a 20-year or not even a 20-year, probably like a 15 to 20-year horizon, if that's what you mean by long term, then yes, it's a good option. But I would suggest you don't, do it now. just wait for a bit more for valuations to correct. Is it good to invest in government securities with a 20-year horizon at an interest rate of 7.3%? So if you're happy with the 7.3% number and your goal or you'll need the money only in 20 years, then yes, you can go for it, because the interest rate that you see is the interest rate that you'll get, right? Especially with government bonds. But if you need the money sometime in between, right, then it depends on where the market is, right? You might need to sell the bond at a discount, or you might get the bond or you can sell the bond at a premium, right? If the situation is really good and interest rates are lower, your 7.3% would get you a premium when you sell the bond in the middle. But what I would suggest is you look at more options, right? You look at something like a corporate bond, where where even if it's like 5 years or 10 years, you can always roll you can always roll it over and and like reinvest your proceedings and make another investment after 5 or 10 years, right? Locking into something for 20 years is always up to the investor. Like, the investor has to be very, very comfortable with that sort of investment horizon. Then, yes, you can look at it. But what I would suggest is, if you have not already considered something like a corporate bond and then rolling it over based on your investment horizon, that would also be a good option for you to explore. Can we invest a lump sum in a balanced fund? Okay. I think you mean a balanced advantage fund by a balanced fund, right? And take a fixed income using SWP. What are the risks involved? Okay. So when you're thinking of hybrid funds, right? They do have a significant exposure to equity, right? And they do take, and it does have that, risk involved, right? Mostly, if it's large cap equity, won't be as much versus like a multi cap, versus like a multi cap hybrid strategy, right? But yes, there are some risks involved there on the equity portion. And when you're taking an SWP, right, you unless the SWP is very, very small, right, you would sort of start to erode capital. So if you're comfortable with that, then the SWP strategy is fine, right? But again, it depends on your investment horizon. If you have an investment horizon of more than say 3 years, right, then you could start looking at this strategy. Otherwise, I would suggest you stick to fixed income for an SWP. But nevertheless, right, in most cases, SWP do have some sort of a capital erosion component involved. State government guaranteed bonds, depends on the state. Most of it should be fine. But then again, I would suggest you, come to a professional and, or do your homework before investing in a state government. You said less than 5 years and preferred duration is 3 years as the yield curve is flat. Indian yields are following US rates. Do you believe the rates to increase as per the last FOMC meeting comments? At that time, don't you feel an adequate premium on Fed duration should be more than what you said, that is less than 3 years? Okay, so for the first question, Mr. Batra, don't you believe interest rates to increase as per the last FOMC meeting comments? I mean, again, it all depends on the data that comes out from America, right? Where if whether they would increase rates or not. So where the data is pointing to now is that they still fear inflation, right? And inflation can always go back up. Right now, it's 3% odd, right? But we don't know what will happen in the coming months, right? So they are still very cognizant of that. Second thing is that and they've been saying this for quite a while now, that they want to see inflation at closer to that target range of 2% for a sustained period of time before they start easing, right? So that is still a very good probability of another rate hike by the end of the year. Although we've seen the last two FOMC meetings, they've been holding rates, but they've still been very hawkish in terms of their outlook. So yes, there is a good possibility of a rate hike, and I don't think we've seen the last of this, right? Even if there is no rate hike, we can expect rates to remain at these levels for the foreseeable future. Don't you feel adequate duration premium should be more than what you see? Okay, so for investment, for the duration premium, I was talking about the domestic market, right? Over here, yes. The yields for, if I can take you back to that slide, right? So the yields for the 10-year and the 2-year, right? Let's take these two examples, is not that significant, right? So when does this correct? This would correct if the 10-year goes up significantly or the 2-year goes down significantly, right? And over here, the more likely, option that you'll, the more likely occurrence, I'm sorry, that you'll get when, yields start going down again, or you have some sort of a dovish stance is, short-term yields going down, right? And short-term yields might go down faster than the long-term yields as well. So that is what I meant by, looking at a 3-year, less than 5-year or a less than 3-year option. So is this a good time to invest in bonds? Yes, sir. You can definitely look to, if you can can stay invested for a period of time, and you have something like and if you have like a decent risk appetite, then yes, you can invest in bonds. Another thing to keep in mind for anyone who's interested in investing in bonds is that in most cases you will need a demat account. Given that interest rates have almost peaked and they may go down slowly over the years, which category of debt mutual funds are good to have? So traditionally, when we're in the peak of an interest rate cycle and interest rates are going down, right? It would be a long-term debt fund, right? But right now, what we're seeing with elevated short-term yields and a flat yield curve, right? A short-term fund is also a really good option. So we won't know unless we won't know until it's played out, but it could be a better option than a long-term debt fund as well. So I would say that for investing in debt right now, I would look at less than 5 year durations. Okay, the last week and this week's webinar link. I'll have my team send it. Okay, would it be a good idea to invest in 10-year bonds and hold to maturity if we're going to see an interest rate reversal in the next year or two as compared to FDs? So there are a lot of other factors as well that you need to consider when investing in, especially the tenure, because the tenure is the benchmark interest rate, right? Since that's the benchmark, you'll have a lot of flows going in and out, right? And then again, it would depend on the government's borrowing plan or and supply and demand mainly of the 10 years. If the tenure is oversupplied, you won't see that much of a gain, even if there is an interest rate reversal, right? If there's not enough demand for the tenure, you're not going to see that differential there. So there are a lot of factors when it comes to playing the tenure. If you can take that sort of risk, then maybe I would before telling you a yes or no, I would like to talk to you a bit more and understand what you want, sir. But yeah. Okay, can I hold investments in a conservative hybrid BAF for the next 1 year? Yes, sir, that should not be a problem. Generally, conservative hybrid funds do invest in something like a large cap or a mega cap equity, right? And that debt exposure is also pretty safe in terms of credit. Although I would suggest that you have another look at what sort of duration they're investing in, right? And what would the debt equity split would be. Okay, gilt funds in the current scenario, again, it's a flat yield curve, right? So you would want to look at something in the shorter end of the yield curve, right? Not something super long. But you do have better options in something like a corporate bond fund, right? And even something like a low duration fund is giving like some sort of a similar yield or a better yield. So I would suggest you look at those options as well before committing to a gift. Right? So some debt mutual fund folios also have an allocation towards rates. Okay, so are those mutual funds safe? How do we do a YTM to YTM comparison with another vanilla debt mutual fund? Basically, how do we evaluate a debt investment having 10 to 15% rates? Okay, so when it comes to rates, right, they usually invest in real estate projects and cash flows from there. So it again depends on the fund. So if you could, get in touch with us as to which fund you're looking at, and we can do something like a full comparison, and then we can make a decision, right? So the debt mutual funds that we advise our clients to invest in don't generally have rates, right? They are something like a corporate bond fund, right, or a low duration fund. That is our current strategy. But if you have any sort of option that you're exploring separately, then yes, we could help you with that. So I would suggest that you get in touch with us and we can take this also. Okay, so we're slightly above the 45 minutes time frame. So if you have any more questions, please do feel free to get in touch with us, right? And yeah, so and the link to the WhatsApp group, I will post it again in the chat. Right. Feel free to join the community. We'll be, active there. You'll have a lot of, information related to fixed income coming in there. And yeah, so I will see all of you in the next webinar. Right. Enjoy your weekend.